You've seen the headlines, right? The news is filled with stories about booming markets like Dallas-Fort Worth, Texas. The numbers are staggering, massive population growth, huge job gains, and people flocking to these cities. It's easy to get swept up in the hype and think, hey, if the whole city is growing, every single multifamily deal there must be a winner. But what if I told you that focusing on these high-level stats is one of the biggest mistakes you can make as a real estate investor? That blindly following the noise can lead you straight into a bad deal, because growth isn't a magic shield that protects your investment. Let's talk about the common misconception. Many limited partners, or LPs, see a headline about a growing city and assume their due diligence is done. They look at net migration numbers and think, yep, that's all I need to know. But here's the reality. A metro like DFW isn't one big homogeneous market. It's a complex patchwork of neighborhoods, each with its own unique story. You could be in a metro with incredible population growth, but your specific submarket might be a disaster. Why? Because the headline doesn't tell you about the local factors. It doesn't tell you if your neighborhood is plagued by high vacancy rates, rising crime, or poor tenant demand. The macro level story, the big, exciting headline, often hides the granular truth. So how do you avoid the trap? You look beyond the hype. The strength of a multifamily deal is rarely about the headline market story. It's about a few key things that require real, boots-on-the-ground due diligence. 1. The operator's experience and transparency. Who is actually running the show? Are they a seasoned operator with a proven track record? Do they have a transparent communication style, or are they opaque about their strategy and numbers? A great operator can turn a good deal into a great one and can mitigate risk in a tough market. 2. The debt strategy. What's the loan on the property? Is it a floating rate loan in a rising interest rate environment? A poorly structured debt strategy can wipe out a deal faster than a bad market. 3. The micro market fundamentals. This is the most critical part. Instead of looking at the entire city, zoom in. What are the local school districts like? What are the crime rates in this specific neighborhood? What are the local economic drivers? Are there new businesses moving in, or are old ones leaving? This is where the real work happens, and it's what separates a smart investor from an emotional one. Believing that population growth alone will protect your capital is a recipe for disaster. It's how many LPs wake up one day to find their investment gone, their capital evaporated, and the booming headline they relied on now just a cruel joke. The next time you see a headline about a hot market, don't just see dollar signs. See a reminder to dig deeper, to ask the tough questions, to focus on the fundamentals that truly matter, the operator, the debt, and the specific submarket. So remember, hype is not the same as a good investment. The most successful investors are the ones who can ignore the noise and focus on what's real. Do your homework, trust your due diligence, and invest with a clear head, not a headline.